Good evening, good evening, good evening, everyone, and welcome to tonight's webinar, which we've been running since 2020. And I have to share with you that, while I was preparing for tonight's session, it dawned on me that exactly 2 years ago this month was the first time we had done a Meet the Money Manager webinar, which was to introduce to our clients and to the community, to the folks and the firms managing their money and their investments. And it just so happens, coincidentally, that yesterday was actually the first time that I went to meet the money manager that we ran a webinar with 2 years ago. I went to meet them at their office in person. So this is my first time meeting them in person, since the pandemic, and I was here in Toronto at Yonge and Eglinton. So I also do my own meet the money managers myself. Typically it was by phone, virtually, and finally now sort of getting that in person as I started. And let's be honest, Yonge and Eglinton is just around the corner from where I am, which is in Leaside, close to Bayview and Eglinton. But one of our managers that's here with us tonight, they're based in California. So at some point, I should head out there to meet that team in person as part of my due diligence. And it's been a pleasure working with them. This is that picture from me yesterday. I'm at the office of Vital Goodman, and to be honest, when we did the dry run session on Monday, it wasn't part of my plan to discuss, any other firm, or and put up this picture. But I think it's going to be helpful for everyone on the call, just to get a tiny bit of context in appreciating the depths and the length of the relationships that we have at RBC as it relates to the quality money managers around the world that we work with. Tonight we've got two of those, two of those money managers. And before we jump into the agenda, I'm just going to share that very brief list, just so you can kind of get a sense of where they fit into the grand scheme of things. So tonight we've got Aristotle, which is based out in California, as I mentioned. And their focus is on U.S. equity. So you'll see that, amongst a list of U.S. equity, Aristotle is one of the firms that is on that list. And you're going to hear a bit more about their story, their history, their expertise, and their process, right? And we also have the privilege of having Baratang with us, which focuses on small and mid-cap Canadian. And below them is Vital Goodman, the firm that I sort of met with yesterday in person. Important to point out, not necessarily is an overlap, because actually in reality, the strategies on the Canadian side sometimes complement, because Baratang's strength is on the small and medium cap, while Vital is on the large cap. So sometimes those actually do complement each other. So I'll leave it there and jump into what you can expect from tonight, right? So in terms of getting back to a regular scheduled programming, what we'll start with first is I'll do a bit of a Slido poll. It helps us to kind of get a sense of those in the audience, and that will sort of help the presenters as well. And then we'll start off with looking at the U.S. side of things with David from Aristotle Capital, and then we'll get into Canadian, but more specifically small and medium cap Canadian stocks. How do you look at the universe of all those companies? How do you screen from a large list to down maybe to a short list of those, right? And then there'll be opportunity for Q&A. Hopefully, we typically try to start Q&A around 7:45 at the earliest, depending on the presentation, maybe a little bit later. And then we'll open up. Once we adjourn, I typically hang around for an Ask Me Anything segment, which could be on what was discussed today or anything of a financial nature. And for those, if you're joining for the first time, my name is Orlando. I'm an advisor with RBC Dividend Securities, been here, it's going to be 4 years now. Most of that time has been during a pandemic scenario, but we're now out of that. And prior to that, I was with another firm working in a similar capacity as a financial planner, as an advisor. So I've always been in this space, and I've also had experience teaching finance at York University. So I bring all of those to my practice in really trying to educate and empower clients as it relates to their finance. So let's get to the Slido poll. And if you've got, depending on whether you're joining us from a mobile device or your computer, you can scan the QR code. So assuming let's say you're on a laptop, you can use your phone, scan that QR code, or you can go to slido.com and input 6275953. So that's 6275953. I'm just going to pull it up here as well. And we'll go into the first question. Let me just get that going. There we go. Okay, perfect. How about that? Okay, there we go. Question number one. Which of the following U.S. vehicles would you want to increase exposure to? So which of these would you want to increase exposure to currently in this kind of market? So on the U.S. side, U.S. GICs, U.S. stocks, or U.S. bonds? Bit of a neck and neck for now. Do it a little bit more, and then we'll ask a question on the Canadian side. So on the left, you'll see the code again on the website, slido.com. Okay, U.S. GICs, interesting. U.S. bonds. Okay, let's see on the Canadian side of things. So on the Canadian side, do you believe that Canadian small cap stocks have the potential to outperform larger, more established companies in the long term? A few persons probably just joined. If you just joined, on the left, you'll see the QR code, or you can go to slido.com to share your thoughts in this. Okay, so that means the presenters have got some work to do. Maybe not, right? So we'll see this discussion here. So good chunk say, and that's a fair response. Not sure, right? And the final one, which might make you scratch your head, but I'll explain. Are you by chance a member of a work pension plan? And I'm going to connect the dots into why this one is being asked. Interesting. Okay, so a majority. Okay. You know, one of the reasons I asked this question, and I'll certainly hand it off quickly, is because what attracted me very early on when I discovered the folks at Aristotle was when I learned that not only do they manage investments for individual clients and institutions, but also for some pension funds. And one of those pension funds is also here locally in Canada. So that's been something, the discipline, and I'm sure many of you in that group that have a work pension, have a sense of comfort. And depending on where you work, if you're, let's say, a lot of the famous popular pensions, teachers' pensions, or for nurses, HOOP, hospital pension, we all agree that it's not the teachers and the principals and the vice principals that's managing the funds in that pension, right? It's not the nurse and the doctors. That's being outsourced, right? So that is outsourced to entities and firms who have that expertise, and we're privileged to have one of those tonight. So without further ado, I am going to hand it off to David to sort of let me know if you've got the control, David, and thank you for joining us, sir.
All right. Well, thank you, Orlando. Thank you, everyone. Hopefully you can hear me and see me as well. I appreciate your time. I know it's around dinner time, so hopefully you're all enjoying something delicious during this conversation. As Orlando mentioned, I'm in California. We're actually headquartered in Los Angeles, but we also have an office in Newport Beach, which is in Orange County. And that's the office that I sit in today. I will share some information with you on my screen now. This is a brief overview of Aristotle as a firm. You can see there's a timeline at the bottom that goes back to 2010. However, Aristotle has roots going back actually in 1997, and we'll talk about that a little bit more in depth as we continue the conversation. But you can see here that Aristotle is a family of actually 5 independent registered investment advisors. Each of these different investment advisors that you see here on the timeline have their own unique focus, specialty investment teams, so they operate in separate silos. And why is that important? Because over time, we've been able to hand lift out very talented individuals from different firms and bring them over to our firm and tell them, you can keep doing exactly what you've been doing. We've hand selected you because of your track record. And basically, we want you to keep doing what you're doing, but we want you to be part of the Aristotle umbrella. And why would someone do that? I'll touch on. I think it's one of our biggest value propositions, but it's the fact that we're independent and we have broad employee ownership. So this is a little bit of an overview of Aristotle as a whole, but what we're going to be talking about today is the strategy, as Orlando mentioned, which is our US large cap value strategy. And that strategy is our flagship mandate. It actually launched at a prior firm that our lead portfolio manager founded called Metropolitan West back in 1997. However, Aristotle goes back to 2010, as we talked about, and you're going to see 3 strategies listed across your screen. The only one we're talking about is the one on the right-hand column, and that's the US large cap value strategy. But you can see here that this investment team is 18 individuals. We'll highlight them on the next page, but they are only focused on these 3 different mandates. So it's a very focused investment team. We consider it a private equity approach to public markets. As Orlando mentioned, our bread and butter historically in terms of our assets and our background is institutional type business. So it says our process and our philosophy has been applied consistently for over 2 decades. That's absolutely correct. So Aristotle launched in 2010, but again, the strategy that we're talking about today actually began in 1997 with one of our longest serving institutional clients, which is American Airlines. So we actually pulled books and records from that account dating back to the prior firm. All of that was considered when RBC Global Manager Research analyst gave us a tier 1 rating and a 4.5 analyst rating when they did the due diligence on us. It wasn't just on the 2010 to current, it was also on the prior track record as well. I'll jump to another slide real quick here. This is touching on what Orlando alluded to in terms of just a sample of some of our largest institutional clients. You know, University of Manitoba is one that jumps off the page on the left-hand side for me at the very bottom, but all kinds of police pension plans, Miami Beach Police and Fire, and these are firms, or these are plans that we've had under our ownership for a long time, right? These are plans that have given us permission to use their name on this document. So typically that means they're satisfied with the long-term performance and service we've been offering them. So the good news is, you know, we really are somewhat exclusive in Canada. This flagship strategy is available in different ways to some extent, but most of it's institutional other than the A+ platform. So an IA investment advisor like Orlando is really the only place that you'll have access to our separate managed account on the A+ platform, because we don't work with some of the other big banks in Canada, at least for this strategy in this vehicle or wrapper. So I think that's an important thing to mention in terms of some of the reputation, the credibility, but also the exclusivity aspect of things as well. Before I go to the next slide, and I plan on talking for 15 minutes. Usually I'm going to be interacting, but I know Orlando has asked for the questions to be at the end, so excuse me for just spewing a bunch of information here. But there's this bullet towards the top left that says independent broad employee ownership. So if I had to kind of drill it down to what I think is really our secret sauce or what makes us unique, It's again the fact that we're independent and we have broad employee ownership. And why is that important and what does that mean? If you look at our next slide, this is our 18-member investment team. Almost every single one of these investment team members is considered a principal or an owner of the firm. And why is that important? Because in terms of eating your own cooking, skin in the game, manager ownership, a meaningful portion of their liquid net worth is invested alongside our clients. And for us, that's the 100% alignment that we want. And that's been in the DNA of Aristotle since day one. We were actually founded by 3 individuals, one of which was that lead portfolio manager I mentioned that came from the prior firm. 2 of the other founders came from that same prior firm. We have 5 board of managers. So since then, 2 other members were added to the board of managers. So that makes 5. And they could have split the firm 5 ways or even 3 ways with the founders, and it still would have been independent, employee owned. But they knew the best way to run a stable steward of clients' assets long term is to share that ownership in the firm with really anyone that has a leadership type role that's steering the ship of Aristotle per se. So now today, fast forward to 2023, we have over 40 owners of Aristotle. And everyone here, including myself, if you're not an owner, you're striving to be an owner, right? That is, I think, hands down how we're able to not only attract really talented and really smart people. Every firm has really smart people, but we're able to really, really retain these individuals. And it's because we're giving them ownership in the firm. I mentioned earlier that we've hand lifted certain investment teams from other big banks over time. And there's no mystery why they've joined us. It's because they wanted ownership in what they were doing. So that's something that we offer. And that's something that's incredibly important. That takes me to my next point here on the investment team is none of these individuals are compensated based on the number of recommendations in the portfolio. And why is that important? Because the last thing we want to do is incentivize one of our analysts to become someone like myself, which is someone more on the sales side of things, right? Because you can have someone that's covering a particular sector or industry, and maybe there's no good opportunities in that sector or industry, but a lot of our competitors are going to compensate their analysts based on how many great ideas they get in the portfolio. And that turns that person into someone that's competing with every other analyst on the team. They're butting heads. If someone gets one of their ideas in, that means that's one less opening for your idea. So here, it's the antithesis of that. You can have someone that's covering a particular sector industry that has 0 holdings in our portfolio, and they can make just as much money as someone that might be covering one of the sectors that we might have 3 or 4 holdings in. And that's really important, right? Sometimes what you don't own is as important or more important than what you do own. So as long as these individuals are collaborating, they're adding value, they're doing their best to share as much information with their colleagues, it really creates that collaborative environment, right? We call it the kind of water cooler environment where everyone is on the same team. If Aristotle wins, our client wins, our clients win, and then the employees here and the analysts and the investment team members win as well. So that's incredibly important. The 2 portfolio managers are listed here at the top left. Howard Gleicher is our lead portfolio manager. He's one of the founders. He's the architect of the strategy that I mentioned that goes back to 1997 at another firm here in the States that he founded back then. The firm still exists today. And Gregory Padilla, he was added in 2018. So from 1997 to 2018, Howard was the sole portfolio manager on the team. When he left the prior firm, he brought his favorite analysts, favorite traders with him. Greg Padilla was first an analyst for many years on the strategy, but then in terms of long-term succession planning, we often get the question, well, what happens when Howard is no longer able to do what he's doing? Part of it is we added a co-portfolio manager several years ago in 2018, but just know that this portfolio has been managed the same exact way going back to 1997. So in terms of the philosophy, the process, the discipline, the style, everything has been ingrained in the DNA of our entire investment team. Not to mention Howard is in his very early 60s. I think he just turned 61, if I'm not mistaken. 62 would be the oldest he could possibly be. I know that for a fact. So he's got many years left many good years left. And this is what he does, right? He went to Harvard. He breathes, lives this type of information, and this type of role and responsibility. He doesn't do calls like
And I know what,
this.
David,
Yeah,
I think what most, even what RBC probably liked was that consistency and predictability in your process. That it's something that has continuity because, we put more focus on that than just looking at, well, what's the past performance, right? Because that sometimes is hard to replicate, but a process and a structure around how you go about, the investing is something that more weight should be put on.
absolutely. Yeah. And that takes me to, it's a great point. So this is our philosophy slide.
Mm.
There's nothing groundbreaking here, Orlando. This is how the portfolio has been run consistently since 1997. Many strategies are managed in this type of fashion, but I think where our secret sauce is, to your point, is the full transparency and the discipline that we use when we're managing the portfolio and choosing what we want to invest in and what we want to sell. So this takes us to what we call our QVC process. So the easy way to remember it is the Home Shopping Network, QVC, but it stands for high quality, attractive valuation, and compelling catalysts. And this drives every decision that our investment team makes. So if you were to ever ask, why does Aristotle own a particular business? The analyst reports that they put together for the portfolio managers. And again, there's 16 analysts, 2 portfolio managers. Every one of them is covering these sectors and industries from a global perspective. So it's not like we have a US special or specified analyst. They're covering it from a global perspective, but they all rotate sectors every handful of years. And they're writing these research proposals for the portfolio managers that are making the final say. And everything is structured in this format. So the business must be high quality. It's got to be attractively valued, and there's got to be some sort of compelling catalyst. To dive a little bit deeper, what does high quality mean?
Can I add one thing too,
Yeah,
which I want people to really zero in on what you just said. I don't know if they caught that you didn't say quality stock. You said business. So you're looking at the business on separate prior to then looking at, well, what is the stock market saying about it? And I think, I don't know if you can probably give a sense of how many business are typically in the universe that you're sort of then first looking at to then wind that down to, okay, out of all these business that we're looking at, these are the ones that are quality, maybe even ballpark.
Absolutely. Yeah, I can tell you the number I have at my fingertips, Orlando, is just with this high quality criteria, our investable universe, which is basically anything that's large cap, is whittled down by 80%. So only about 20% of our investable universe is left over, which is somewhere around 400 to 500 names, just with the first hurdle or first obstacle, which is high quality.
So about 400 is left after you screen for quality.
Absolutely.
Yeah.
Once it passes that first test, only then do we assess whether or not we believe the business is undervalued. And you're spot on. You're never going to hear one of our analysts talk about a stock. We have a business owner mentality. We don't trade pieces of paper. If you look at our turnover, it's about 16% since inception. What does that mean? Portfolios run very tax efficiently. Every decision we make is based on a 3 and 5 year forward-looking time horizon. And if you looked at the 42 holdings within our portfolio today, our average holding period is over 7 years. So we practice what we preach in terms of being long-term. And all of that goes back to the investment team. We believe our greatest competitive advantage is the fact that we have so many owners and they're not competing against each other. And we allow them the patience to have their undervalued ideas come to fruition. We're not always right, but the good news is we're right more often than we're wrong. And we allow our investment team to have patience. No one is making any decisions based on what's going to happen in the next 3 months, 6 months, next year. Everything is 3 to 5 years forward looking. And
you mentioned 42, 40. So start out, you screen for quality, brings it down to about 400, and then do some other screens based on valuation, and you're then bringing that down to about 42 that is met these criteria. And one thing that probably makes me come to mind and I do come across individuals that will sort of say, well, how hard could this be? I can do it myself. I don't think that majority of any investors doing it themselves is really even looking at 400 business. Maybe they're looking at the stock price, and if they're looking at 400, I doubt that as well, because one thing that large team allows for that invested time to do that. So that's something that I think is a big plus.
Yeah, and that's all they do. And to be honest, they're spending their time not necessarily scouring the globe for new ideas. I'm going to flip ahead, but this is an example of one of our holdings. It's actually an international holding that resides in our US portfolio. Sony's obviously based in Japan, but it's a household name here in the States and in Canada and the rest of the world. This is I guess this is kind of a metaphor of how we find new ideas. We like to say great ideas find us. So you mentioned screening earlier, Orlando. We don't do any screening whatsoever. So yes, that's our investable universe kind of whittling down, but we actually flip our portfolio on its head and we work from the existing holdings. So this is kind of an example of Sony, a business we purchased in 2018, but how it's related to some competitors, some of which we've owned in the past, some of which we currently own. Microsoft in the video game industry, as an example. Some are businesses that we've just researched in the past, but we've never invested in, or maybe we've invested in it in one of our other strategies. So it's that ecosystem or that web of information. And I think that's important because we're not just looking for great ideas. We are spending all of our time on the 42 names within our portfolio and making sure that every single one of them at all times, not just when we make the initial purchase, but it must be maintained at all times, that QVC. So they must be all high quality, they must be attractively valued, and then there must be some sort of compelling catalyst that the business has direct control over that's going to get that undervalued business to where it needs to go from point A to point B in the next 3 to 5 years. And that's usually the X factor. That's what's not baked into the price. That's what others might be missing, is that catalyst. It's something that's currently underway, but it's something that the business has direct control over that's going to allow that business to reach their full potential. And that QVC philosophy or process has to be intact at all times. The most common reason for us to sell something is because just one of those deteriorates or is realized. A lot of times, exactly what we predicted to happen happens, but we then have to collect some profits and sell the business because it's either, the price is now fair or the catalysts have all been realized and we don't see any other catalyst and we're going to swap it out for something that we feel is more optimal. So I'll stop there. I think I might have taken my time already. You tell me if we can go further, if there's any questions.
Yeah. What other company would be an example? And probably we'll end it off at just one other example.
Yeah, there's an example here in this deck just because they're a recent purchase in the portfolio. This is Merck. It's an investment example. It's one of the world's largest pharmaceutical companies that develops drugs used to treat conditions in areas such as oncology, vaccines, diabetes, animal health, etc. But you can see here again, it's how is this business high quality, how it's attractively valued, and what's the X factor? What's the compelling catalyst that's going to get that business from point A to point B over the next 3 to 5 years? And not to spend a ton of time on this because we have this same similar slide for all 42 names within the portfolio. So it's not an isolated case. If you want to talk about a recent purchase, the most recent purchase was actually Activision Blizzard, a business that a lot of us might be familiar with. But we purchased that business just last quarter. So that's the most recent purchase. And I'm happy to dive a little bit deeper, but
thank you. Yeah. So in the interest of time, I'm going to actually say that, I think, I hope those on the call would agree with us. I think the way you presented it is top notch and, high quality. You made a compelling case as to why Aristotle will be an attractive sort of firm to include or to leverage, and on the U.S. side, right? And that's your strength, right? Which is what attracted me in the first place in bringing this to clients as something that we can include in their strategy. Now, as part of a portfolio and constructing it and getting diversification, geographic diversification is part of what is important to me and to clients. getting some exposure to Canadian is one of those. And we're going to look at that. I'm going to ask Sean to touch on that, right? But I will say that for most Canadians, I think it's pretty normal that there will be a lot more comfort and a lot of exposure to the usual suspects, right? The big banks, you know, a lot of Canadians like to own the banks. But we don't have we don't have a lot of other industries like the US. We don't have a big tech sector. We don't have a very big healthcare sector. And that leaves few sectors. So you've got few sectors and just the big, you know, usual suspects get the attention. And that could actually create, in my mind, a bit of an opportunity for what is overlooked. And that's something that I'm, you know, happy that we've got Baratang and Sean just to touch on that. And there might be some preconceived notions about small and mid cap. So Sean, glad that you can join us today.
Just going to, can everybody hear me okay there?
Yeah.
Great, and I'm going to take back the presentation here, yeah.
Yeah, just put it back up again. It was up earlier just now.
Yeah, I just wanted to make sure my video was on. Yeah, thanks very much, Orlando, and tough to follow such a great presentation David put together. Certainly, when I'm hearing him talk about employee ownership and the quality value approach, a lot of similarities, but where he's sort of focused on large cap and very large market, the focus today will be small cap Canada, and hopefully I can convince you that small can be beautiful. So we are a boutique asset manager, 1.4 billion in assets under management. We're value focused. We run focused portfolios, low turnover. We are 100% employee owned. There's 7 shareholders, myself included. And really, we got our start, founded in 1995. We got our start in high net worth private clients, and have sort of grown up over the years where about a third of those assets are still high net worth. A third is traditional pensions, foundations, endowments. And then a third is growing on the bank distribution, whether that's sub-advised or that's on the SMA platforms like A+. So just looking ahead here, got the team slide up, and wanted to show, so our CEO, CIO, Wally Custers, who came over to Barantaw in the early 2000s. He heads up sort of both the Canadian and global and fixed income equity teams. And then the remaining 3 on this chart here are our Canadian equity managers. So John and Adam focus on all cap Canadian equity and Canadian equity income, and then myself is small mid cap equities. So just diving into approach, and Orlando sort of teed this up for me, but off the start, we just wanted to sort of put aside some misconceptions about what small cap Canadian equity can mean. And a lot of people will think that's sort of very heavy resource industries, energy mining, maybe biotech, maybe cannabis. That is not what we do. So we're looking for, you know, established industry and niche leaders. These are companies that, you know, have a national footprint, in many cases an international footprint. And even though they're small from a market capitalization size, which means, you know, they're not covered to the same extent as your BCEs and your Enbridges on Bay Street, they're very large from an actual established business, defensible cash flows, and we can find some hidden gems from a capital market standpoint that are very established businesses. So not unlike Aristotle, sorry about that, here we go. We define ourselves as quality value. So what does quality mean? We're really looking for, as I said, those established leaders, and we're looking for a defensible moat around the business that's going to allow them to earn attractive economics and a runway to deploy capital over time. And so that sort of competitive advantage can be it can be generated in a few different ways. It can be something like a strong brand presence, like Jameson Wellness, a 100-year-old brand in Canada. It can be something like regulatory or barriers, economies of scale, where something like a cargo jet, which has 90% market share in air freight in Canada, where foreign entrants can't come in and fly from port to port. Or it can even be something like industry structure, something like a Boyd Group, which does collision repair centers, that just by nature of that industry, as they get larger, the insurance companies are more incentivized to send business their way. So that's what we really mean by superior businesses. We tack on capable management team. We're looking for owner's mindset. Do they have skin in the game? Do they do what they say they're going to do? Do they under promise, over deliver? And really that combination allows us to have a lot of faith in the capital we put to work. And the last piece of the puzzle is valuation. So it's independent, it's bottoms up, it's cash flow focused, buy sell targets. We look to build up our independent assessment of intrinsic value and buy at a nice margin of safety to that. So the process can kind of be distilled down to 5 steps. And even though this is in consecutive approach, it's a very iterative process. So the first step might be sort of some financial screening. And Orlando was asking some questions around, what we're looking for in business. So this is, do the financial metrics support this as a quality business? How are margins doing? How cyclical is it? What's the growth been like? What's the return on capital? What's the leverage like? So that allows us to find some ideas and to sort of verify what we're hearing and seeing in the market and seeing with results. And then the second part is on the qualitative side. And certainly this is the piece that takes the most amount of time. And we're really trying to put the pieces together. What's the story behind those numbers? How defensible is the strong economics? Are there risks out there to that that might change over time? And we build up the thesis that way. Throughout the process, we're looking to meet management. We might have an initial meeting at an industry conference, certainly combing through conference calls to hear how management talks about the business, and then following up with in-person or virtual meetings. And one of the beauties of being in the small cap space is we have great access to management. So we're 1.4 billion asset under management firm. Small cap's a big part of what we do, and we take sizable focused positions in these companies. So we really do have the ear of management to better understand the business, which is helpful. And throughout, we're building up that valuation. As I said, really conservative assumptions is what we're looking for. We don't want to shoot the lights out in terms of pricing for perfection to justify a buy. And once we're comfortable there, it comes down to the pitch to the rest of the investment team. You saw half of it on the slide I had. We also have two global equity PMs and a fixed income PM. And we kind of describe this as running the gauntlet. So we're going through the thesis on an idea. They're poking holes in it. We might be going back to get better answers to the question and getting everybody on side with a new idea.
Sean, I think,
yeah.
I don't know if you guys have described it this way, but what kind of came to mind, and maybe the way I would describe what your firm does, I kind of equate it to what happens within, think about you're trying to find that top-notch basketball player before they hit the NBA. You're like talent scouts. Before they blow up, everybody knows who they are. You're trying to find them at an early stage, because everybody will know who they are when they hit the NBA to become big. But you're looking at the high school and the college level before.
It's a very astute observation. I feel like when things work the way they're supposed to, we've identified, as you say, that junior college player who is just doing something special, but all the large asset managers can't really get involved, and it's going to trade at sort of a very attractive valuation. It's got that sort of small cap discount, and then the combination of them compounding capital at amazing rates of returns, the business growing, more eyeballs on it, the valuation gap closing. It can be a wonderful thing, sort of finding those small cap compounders. And our portfolio turnover is quite low, 15 to 20%. We have 25 to 35 names ish in the portfolio. And so, when we get it right, we like to own businesses for a long time.
Yeah, and they don't all make it to the NBA, which is just part of the business. It doesn't always.
Yes, correct. So moving ahead here, just on the portfolio management side, so we do look for 40% return over 3 years. As I said, it's that low turnover. We're not looking to buy and flip an idea. And really, one of the things we can bring is through that diligent analysis, the time arbitrage to see the market might be focused on 1 quarter or 2 quarters or even a year, but there's something special and there's an opening valuation opportunity in a great business, and we can use that time arbitrage to our benefit. And once we own it and it's in the portfolio, then we're really monitoring what's happening. So has the stock meaningfully outperformed? Maybe there's good reason. Maybe the fundamentals have improved. We're updating our models and our target price is up, and that's that kind of dream scenario that we love, is where we get these compounding businesses that the intrinsic value grows along with the stock price. Maybe the stock's gotten ahead of itself. Maybe sentiment is full and the valuation on the stock is full, and we can sell at fair value. And then, of course, sometimes you get it wrong. The market disagrees with you, meaningfully underperforms. In a lot of cases, that might be just due to something transitory or short term, in which case it gives us an opportunity to buy a great business for cheaper, which we like doing. And then in some cases, we just get it wrong. The thesis has changed, something has changed. Management has not done what they've said they're going to do, and our value's impaired, and we exit the position. So that's a little bit on the portfolio management side. We just wanted to, and I'm just looking at the clock here, we'll go through this quickly, but a few observations about small cap Canadian equities, which I think might be helpful to the listener. So first off, this is looking June 30th, just performance year to date and trailing 12 months. And you might be aware of this, but there's been a huge dichotomy in returns over the last year where small has underperformed. The smallest companies in Canada have actually are down year to date. And that obviously flies in the face of, large cap NASDAQ type stocks doing incredibly well, some deeper cyclicals bouncing this year that were under pressure last year. And so it has been very a have and have not market. And though it's been a little bit painful this year, the chart on the right here is just showing that valuation discount based on the 5-year average in different market cap buckets. So we are seeing very compelling value in small cap right now. And that's because the businesses themselves have been quite resilient in this environment. Some of the fears in the market are overblown, but certainly we've seen valuation multiples compress, and that's really setting up a nice opportunity for small caps outperforming in the future, especially as we see sort of rates plateau and that external macro on both valuations and sentiment kind of abates. And one of the things we really like about small cap, and this is never part of the thesis, but a chart we like to show clients, is that there's optionality. So when that valuation discount can persist for too long, what happens? You can have a private company step in for a takeout. You can have a strategic buyer take in for a takeout. And this is really looking at all the M&A in Canada since 2019 and the frequency of those takeouts. And you can see about 80% of the deals are in under 3 billion market cap. So it's about 6 times more likely that small caps are taken out. It makes sense intuitively. Small companies are smaller size for large buyers to take in. But importantly, look at the takeout premium and the under 3 billion and the over 3 billion. And it's about double. So large cap companies taken out for on average 18% premium, small caps 37%. So when we see those valuation discounts persist for too long, we never know when this is going to happen, but it's a nice backstop. It's nice optionality. And the chart on the right there is just showing some of our holdings that we've had over the last few years that have benefited from this.
I think most people recognize Enercare on that list, and probably LifeWorks too.
Yeah. Those actually both of those businesses really tick the boxes of those sort of stable, defensible cash flows, and the market taking a very short-term lens to things happening at the company. And opening up an attractive opening for a strategic buyer, whether it was Brookfield or TELUS Health. Another chart, just I'll touch on quickly here. We borrowed this from a JP Morgan study, but over long periods of time, what we find is as growth slows in a lower growth environment, small caps outperform meaningfully. So this is just looking at Japanese equities, which everybody knows has been a low growth place for a long time. And you see small caps outperform mid caps, outperform large caps. And so it's one of the things that we touch on in terms of the small cap advantage, which I'll wrap up. Performance here, I'm not going to touch on this in much detail other than to say you can see in the year to date, small caps has been challenging, have underperformed. I'll point you to the calendar year returns on the bottom, and you'll see the periods in red where we've underperformed are typically resource-led markets. They're typically a bounce off the bottom, where we will lag when it's really speculative risk on. And the good news is that doesn't tend to persist for very long. And by protecting capital on the downside and maybe not, bouncing quite as hard as some of the really beaten up names, that combination over time can be quite powerful. And this is just the risk-adjusted return since inception, the start of 2008. And we've got the strong, absolute annualized return, but the very low standard deviation is key. And that drives, really outstanding risk-adjusted returns. And that can be illustrated with the upside downside capture on the right. And the blue bars there is looking at against the TSX composite, so large cap Canadian stocks. So, when we showed those logos and the type of names we invest in, from a downside capture, just 60% of large cap stocks. And when people think of small cap Canada, that's not what they think of. So this is really, we're buying good quality businesses at attractive valuations, that defensibility business model, and we're able to, guard capital in downturns and then hopefully make hay when the sun shines as well.
Yeah, so we're clarifying that these are not penny stocks.
Correct.
Really put it out there. Yeah.
And putting that together, you can see since inception where the performance has been against Canadian small cap universe peers, against large cap, and importantly against global. So we all know that global equities have been extremely strong. U.S. equities sort of outperforming Canadian stocks over the last decade or so. But this approach, small cap and picking your spots, has worked well. And so out the top of the box there is in the top 5%. One really important takeaway on this slide, if you look at the Canadian small cap universe on the left, the blue dot at the bottom, that's the benchmark. That's the TSX small cap index. You cannot have a passive approach to small cap Canada. It's 50% resources. It's boom or bust. So basically the benchmark has underperformed 95% of managers. And it's just an important comment, and it leads to the next slide here. Junior golds. So we avoid the space. We find that provides addition by subtraction. You can see the gray bar there is the commodity has had sort of modest returns over this period. But importantly, the junior gold miners, which are upwards of 20% of the benchmark, tend to underperform the commodity over long periods. And that's because they're really putting shareholder money into the ground at subpar rates of return. Executives are paying themselves extremely big salaries. And we just find there can be periods of time, like the last year, where gold and gold stocks do relatively well, and it's painful on a relative basis. But over time, really avoiding that sector is something that's helped us, and we've compounded capital at a much higher rate. So yeah, just summing up, small can be beautiful. Higher growth, we love the takeout optionality. A couple slides we haven't shown here in the interest of time, but typically higher inside ownership, higher management ownership, and the information advantage that I sort of talked about. Less coverage on these stocks, more opportunity for alpha, more opportunity to do the diligent research and uncover something that we think the market is missing. So I'll end here on just a few summary of the portfolio and a couple names here. So you can see 28 names. This is at June 30th across 10 sectors. So focused portfolio. Average market cap 2.5 billion. That's, we've seen a lot of growth in the portfolio names. The chart in the top right is showing that diversification by market cap, sort of small cap sector. So we've got a few micro caps under 500 and then more up into the small and small mid. The chart in the bottom left is showing the diversification by sector versus the bench. So big underweight in materials. We don't do the junior miners, as I was just talking about. And an overweight, our biggest overweight you can see is in industrials. And what we find is that that's really a melting pot sector for a lot of non-correlated businesses, good cash flow growth, and good opportunity to compound over time. And just getting into a couple examples, I mentioned these names and what we're looking for from a quality business. So just to allude on them, and this one's the Boyd Group, their collision repair operator. And this is a look back to last June. And if you can remember, what the market was focused on was really just supply chain constraints, labor inflation, and the collision repair operators aren't able to raise prices until the insurance companies raise their premiums. And so Boyd was seeing a margin squeeze. And this is a great business. It's been a long-term compounder, but the market was myopically focused on the margin squeeze in this quarter and maybe the next quarter and maybe even the next quarter. And what that did was that opened up a huge opportunity for a long-term compounding business that was all of a sudden going on sale. And what we took comfort in is we knew the demand was there. Vehicle miles driven were coming back. It was not a demand issue. And then we're quite comfortable with this management team being able to navigate the skinnier margin period, and that the insurance companies would raise rates. They want to see a healthy repair industry, and that needs to happen. And so Boyd, as one of the larger operators, was going to be able to manage it better than most, and would kind of be able to then recapture that margin as insurance companies raise rates. And that's what happened, and the stock has had a good run since. And if we move ahead to my second example, and the reason I show the Boyd as a look back is we see a lot of similarities with the cargo jet. And so here's a business, as I said, 90% market share of Canadian air freight. It's really got a huge moat around the business, but the market is myopically focused on the current freight demand. So we know that the freight environment is slowing. We know that there's more air cargo supply, especially as more passengers are getting on airplanes and you've got that belly capacity. So these are things that are well known. And there's the view that cargo jet is just a one-trick pandemic winner. So they certainly, their business benefited huge in the pandemic from the acceleration of e-commerce. They even were able to do a lot of ad hoc charters to bring in PP&E to Canada and things like that. But the market is just assuming that this slow freight environment is going to last forever. And now the market is completely forgetting about all the things that previously people liked about the business, we love about the business, that mode, as I said, but also the structural tailwinds from e-commerce, the contracted revenues with inflation escalators and fuel pass-through. And so, we can't tell you that next quarter things are going to bounce back, and certainly that's not what we model. But what we can tell you is this too shall pass. And the company has a good balance sheet. It's deferred, its fleet growth plan so that it can maintain profitability and cash flow. And then all of a sudden, we're starting to see in some of the macro indicators that those freight volumes, air freight volumes, sort of bottoming, and the valuation opportunity that has opened up in the name is really interesting. So we see a lot of similarities to Boyd last year. This cargo jet is an example of something we're seeing across some of the small cap quality value universe, where it's what have you done for me lately? It's not, how strong is this business and what does it look going forward? And I'll just finish.
Go back before, just on that previous slide. I want to touch on a few things. So Boyd was just added, right?
Boyd was added last June. In June 22. Yeah, it's a long-term holding, but we added to the position. Yes.
Okay, and the reason I'm pointing that out, I just want people to zoom in on the chart on the right and just zoom in on the fact that there's two lines in red, and that's where you trimmed your position. So Correct. You had cargo jet, and cargo jet, airline company, but focuses on not moving people, moving things.
Yeah.
Benefited, and definitely, everybody understood why a lot of stuff needed to move back and forth during COVID, because everybody was doing online shopping.
Yeah.
So there was a run up, and that's when there was some trimming, took some money off the table, and now you're adding in. So that's something that I think I want people to really take away from this, which is, there's one, identifying it in the first place. There's two, what do you do after the fact? Do you just sit on it into perpetuity? And maybe that's kind of, sometimes there might be some people who sat on, I don't know, Shopify as it went down, and a whole bunch of different names, and BlackBerry, whatever it might be, right? But you strategically, based on your intel, took money off the table, which is with discipline, taking out the emotion of greed to sort of just hold on because it's running up during the pandemic. And that, I think, is that's what sticks out to me, and I'm hoping people are sort of able to see that on that chart on the right.
Yeah, absolutely, Orlando. And just so that we finish here, we've got the detail of the portfolio at June 30th, and you can see this is the 28 names across the 10 sectors, and it's just highlighting the Q2 transaction. So one new name put into the portfolio, that's the Ag Growth. They're a leading provider of grain handling and storage equipment. And importantly, the key driver there is crop volumes, not grain prices. So there is cyclicality with the business for sure, but a lot less cyclicality than just being purely dependent on sort of those grain prices. And what we found here, we were talking a lot about catalysts earlier, Aristotle going into depth into that key part of their process. AgGrowth had a new CEO come in, and the strategy completely changed from sort of growth by any means, acquisition growth, where they over-levered the balance sheet, to really focusing internally on operational excellence, margin enhancement, organic growth, deleveraging, really just tackling the low-hanging fruit to an underlying great business. And that allowed us to, that catalyst of that change and the balance sheet getting back on side really allowed us an entry point and quite attractive valuation in the name, in our view, with a sort of a de-risked growth profile and some nice secular tailwinds there with growing population, growing need for grain storage. So that new name added, it's a very small weight right now. That just comes down to the June 30th cutoff here. That rate has gone up as we filled out the position. And Boyd Group was used as a trim and has continued to trim down, just given the strong run, managing the position size, and just a lower return to our target after the strong run. So those were the moves in the quarter. You should be asking a question if you see green and red all over this in a 3-month period, just given our sort of 15 to 20% long-term turnover. But wanted to highlight those, and yeah, I'll give it back to you, Orlando, and can answer any questions on names or our firm or our process. And thanks very much for the opportunity.
Yeah, no, appreciate it. Thank you. So at this time, I will, open up for questions, and let me just make sure I can see. There is a raise hand feature, so you should be able to raise your hands, and then I will unmute you. So that could be a question, whether it might be for Aristotle on the US side, or for Marathon on a small to medium cap Canadian side. And I also should, going forward, also mention, I kept thinking small cap, but medium cap as well, is probably what would be more accurate. So let me just take another scroll to see if there's any raised. And I know I kept asking lots of questions because curiosity is always there. I see a lot of value in what your firms bring to the table, the approach that you take. I think there are things that, as individual investors, that could be missed, could be overlooked from an opportunity point of view. I also don't think that it's an either or, right? It shouldn't be necessarily either US or Canada, small cap or large cap. There could be all combined and to different degrees to sort of complement that portfolio. So, something that I think folks on the call can sort of be aware of what some of the opportunity set that's there, right? Are you exposed to the US at all? It's not uncommon that investors in Canada will be, will go with the familiarity, right? The companies that they know, that they're familiar with. It happens everywhere. Australians are not necessarily invested in the Canadian banks, right? Because they don't know a TD and RBC, right? They don't know Metro Supermarket, so they stick with what they know, right? And that's sort of why there's value even in that space. And we didn't do that today. We touched on the global equity, but that is something that is on the table from a diversification, right? So geographic diversification. So I think what you've all done is you really sort of shed a light for those who are joining for the first time. And even though I'm familiar with a lot of your process, it's always refreshing to sort of be reacquainted with the level of detail that you go through. And what I'm going to do, I'm going to share what we've got coming up next, and I'll still keep an eye to see if there's any any questions that anyone might have. So we've kind of on the tail end of 2023, and got one more webinar coming up on the 22nd. So I started to sort of alternate, so every other month. And in November, the topic we're going to be focusing on is, that one is called Noted Principal is Protected. So that's going to look at a vehicle or product called Principal Protected Notes. And it's something that shares some similarity with what people will be more familiar with, GICs, guaranteed investment certificates, which provides that peace of mind security in protecting one's capital, right? Protecting that capital, protecting that principal. What it does, which that vehicle doesn't do, is that it does offer more upside. So that's something that just within the context of what the environment that we're in, where interest rate is, as it relates to mortgages, GICs, I felt that this would be something that will be helpful to sort of touch on, right? Other ways to protecting one's principal, right? So that'll be November 22nd. It's not yet on the website for registration, but that will be up shortly, right? And as always, the call to action is to continue to join these sessions, continue to learn, to get empowered, and to share that information, right? And to have conversations with family and friends, so that we're all continuing to learn from each other, right? I mean, I openly tell and say to individuals, I continue to learn, right? I continue to learn from the individuals within my firm, outside of my firm, such as David, Sean, and as I learn, I continue to sort of share that information, right? Because the whole idea is three key pillars: education, empowerment, and the final most important one is execution, right? So it's nice, it's all good and well to have that information, but is it actually being used or utilized, right? So the execution is one that can be a challenging thing for some individuals, because they might have a busy life, a lot of moving pieces, a lot of things on their plate. So that's something that we're able to streamline and to simplify, and just to make it a little bit easier to get across that finish line. And I'm looking at the time, it is just 8:01. So I'm going to sort of then, in the interest of time, just say that, David and Sean, I certainly appreciate that you're able to join. It's not the we've already been using your strategies for clients, but it's good that we're able to sort of allow a lot more to sort of be exposed to the strategy, right? And to the discipline and to the focus. And certainly there's some folks that weren't able to join, but the recording will be made available as well. There is one question, I guess, before you go. I'm gonna unmute Sean. All right, I'll take a look to see if there's any other question or comment. And if not, I'll hang around for a little bit, like I mentioned, just for an Ask Me Anything sort of segment. And David and Sean, enjoy the evening on the West Coast, David. Probably still have a little bit more sunlight left over there. And at some point, yeah, it's coming to your window. Yeah, tell the team, whenever they want me to come over to do a due diligence and to come meet the team, I will not turn it down.
Love to have you.
So, all right. Thank you.
Thanks very much, Orlando. Appreciate the opportunity to talk.
Yeah,
Thank
you're
you,
most welcome. Okay,
Take care.
take care. Bye.